Training modern artificial intelligence models today requires vast, densely packed digital infrastructure. Those sprawling data centers consume massive amounts of electricity 24 hours a day, 7 days a week. To keep server racks running without interruption, grid operators require baseload power, electricity flowing constantly at maximum output. Intermittent sources like solar and wind drop off when weather changes, creating a gap that currently requires massive storage or transmission upgrades to bridge. When you look for energy sources capable of generating stable, high-output electricity on an industrial scale without carbon emissions, nuclear power offers a unique solution. Given the current limitations of grid storage and the sheer scale of energy required by AI, many governments are concluding that decarbonization targets and digital growth require a significant resurgence in nuclear generation. While the technical need for stable power is growing, the nuclear industry itself has a long history of being politically and financially unattractive. The sector operates through two difficult economic cycles. It relies on a volatile commodity market for its uranium fuel and an incredibly slow infrastructure cycle to build the reactors that consume it. Intense regulatory oversight and enormous capital requirements create significant barriers to entry. A single reactor can take over a decade to build, carrying immense execution risk for the duration of the project. Building a reactor is an engineering feat, but for investors, the real difficulty is staying solvent through years of delays and shifting capital costs. After the Fukushima disaster in 2011, reactor shutdowns crushed demand expectations. The market was left with an oversupply of fuel, causing uranium prices to collapse for nearly a decade. That prolonged price slump led to the closure of many mines and a total collapse in exploration spending. Because new mines take years to permit and develop, the sector is now facing a structural supply deficit just as reactor demand is beginning to rise. Uranium mining is highly profitable during a price surge. Once operational, infrastructure costs, like heavy machinery and transport, are largely fixed, creating significant operating leverage. If market prices climb 25% while costs stay flat, operating profit increases by a much higher percentage. The slow supply response of the mining sector means that when markets tighten, prices tend to move sharply and violently until new production can finally be brought online. While fuel producers manage fast-moving price cycles, the utilities that buy the fuel must manage timelines that stretch across decades. Building a nuclear reactor is one of the most capital-intensive infrastructure projects in the energy sector. Because projects are financed with debt, interest accumulates long before any electricity is sold. This financing clock adds billions over a 10-year construction window. If regulatory delays or labor shortages extend the timeline, compounding interest pushes the final cost far beyond the initial budget. In the nuclear sector, time is a financial liability. Every year of delay punishes the utility's balance sheet and erodes the return on invested capital. Consider two utilities building the same reactor. Company A uses long-duration, fixed-rate debt and deep liquidity reserves. Company B uses high leverage, betting on permanently low rates. When a delay hits, Company B's compounding debt threatens its survival, while Company A's conservative structure endures. Infrastructure projects with these timescales heavily penalize aggressive debt management. In nuclear energy, a conservative balance sheet is just as important as the engineering itself. To try and break this cycle of delays and debt, the industry is moving towards small modular reactors, or SMRs. These designs use standardized components built in a factory setting, aiming to lower costs and shorten construction timelines. However, even if SMRs simplify construction, they cannot escape the geopolitical reality of the fuel cycle. Uranium supply and enrichment capacity remain concentrated in a small number of countries, turning fuel security into a national security issue. Moving to modular designs may reduce construction complexity, but it doesn't eliminate risk. It simply shifts the focus toward geopolitical and supply chain vulnerabilities. The success of this current nuclear expansion will be determined by how well the industry manages its capital over the next decade. In the optimistic future, rising demand from AI data centers and government support lead to a disciplined, multi-decade expansion that provides stable, low-carbon power to the digital economy. But there is also a pessimistic scenario where repeated cost overruns and excessive debt leverage collapse the sector, repeating the financial mistakes that have hindered the industry for decades. To understand which direction the sector is moving, analysts are closely monitoring utility debt-to-equity ratios, reactor construction timelines, and the volume of long-term uranium contracts being signed. Nuclear energy is becoming strategically important again, but that importance doesn't guarantee profit. The sector will only power the future if its producers can finally master the capital cycles that have historically defined it.